Today, we will talk about commingled funds. A commingled fund is when an investment manager accumulates money from several investors and combines it into one fund. The purpose is to reduce the costs of managing the constituent accounts separately. These funds are not publicly listed or available to individual retail investors. Instead, they are used in closed retirement plans, pension funds, insurance policies, and other institutional accounts. Commingling involves combining assets contributed by investors into a single fund or investment vehicle. Commingled funds are similar to mutual funds, as they are professionally managed by one or more fund managers and invest in basic financial instruments such as stocks and bonds. However, the major difference is that commingled funds are not regulated by the SEC. Instead, they are subject to review by the United States Office of the Comptroller of the Currency and individual state regulators. One of the key differences between mutual funds and commingled funds is the oversight. While mutual funds are regulated by the SEC, commingled funds are not. Instead, they are subject to review by the United States Office of the Comptroller of the Currency and individual state regulators. Commingled funds have a summary plan description instead of a prospectus, which offers more detail and includes the fund's objectives, investment strategy, and background of its managers. One of the advantages of commingled funds is lower legal expenses and operating costs, resulting in lower expenses and better net returns compared to mutual funds with the same gross performance. However, a disadvantage is that they do not have ticker symbols and are not publicly traded, making it difficult for outside investors to track the fund's capital gains, dividends, and interest income. An example of a commingled fund is the Fidelity Contrafund Commingled Pool, which is similar to its mutual fund counterpart. This fund has a portfolio manager and publicly discloses pertinent information via quarterly reports. It focuses on large-cap growth stocks and has a lower expense ratio compared to the average expense ratio of mutual funds. In some cases, the commingling of funds may be illegal, such as when an investment manager combines client money with their own or their firm's in violation of a contract. Investment managers have a fiduciary responsibility to manage assets according to certain specifications and standards, and assets agreed to be managed as separate cannot be commingled. Here are 4 key takeaways. 1. A commingled fund is a type of pooled fund that combines money from several investors into one fund. 2. Commingled funds are not regulated by the SEC and do not have ticker symbols, making them unavailable for individual purchase. 3. Commingled funds provide lower costs and better net returns compared to mutual funds, but may also present difficulties for outside investors to track fund information. 4. One example of a commingled fund is the Fidelity Contrafund Commingled Pool, which is similar to its mutual fund counterpart. Hope this would help. Thanks for watching.